I'm going to start recording. All right, everyone, it's Matt Donaghue with Mission Financial Planners, along with Jason Duffaut, also with Mission Financial Planners, and Jack Elder with Kestra Insurance Planning, formerly known as CBS Brokerage. Today, we are going to continue our business succession conversation that we started a few weeks ago. If you recall, a few weeks ago, we had partners from Creo on with us, and we talked about valuation, mergers and acquisitions, some of the issues that business owners are going to face as they're getting ready to transact their way out of the business. Well, now we're talking about a whole different kind of transaction, and it's maybe where you ran into a car and you didn't walk away from it. And how does your business get you out of the business so the business can move on, but also so your family can get what they need to get out of the business at the same time? That's the whole point of an insured buy-sell agreement for all of you business owners out there. So that's what we're going to focus on today. Before we jump into it, though, just a couple housekeeping things we like to always make sure we cover. Just remember, at Mission Financial Planners, our job, our mission, our role is to help people make informed financial decisions. We want to be a trusted resource for people so that when you do have questions, you know to come to us, and you know that when you work with Mission Financial Planners, the worst case scenario is we're going to say, hey, let me double check and get back to you. And in that case, then we might be calling Jack to say, hey, I got something here I'm not sure about. What do you think? So that's why we bring people like Jack to the table for these types of events, because we want you to understand that our commitment is to get you the right information so you can make a good decision with it. We have three partners at Mission Financial Planners. Jason and I are on today. I'll be the MC for today. Jason, take a minute, reintroduce yourself to everyone. I won't say anything more. You guys probably know I will talk if you let me. So, Jason, go ahead, introduce yourself, talk about your expertise and specialties.
Yeah, sure. Thanks, Matt. Great to meet everyone here on this call. My specialty is really dealing with the planning part of our business. So I've dealt with succession planning with business owners, helping them exit the business. From that end, I am a certified exit planner. I'm also a chartered advisor in philanthropy, which means a lot of times when we make exits, we try to make important tax decisions around how we manage that tax event of the exit. And the chartered advisor in philanthropy helps me get people the experience they need and save on taxes from that end with that part. So after about 25 years of being in this business, I've seen a lot of different things with business owners and able to provide great guidance around how to get that business headed in the right direction and how to get the maximum valuation and pay the least amount of tax. And with the help of partners like Jack, it really makes it a win-win.
Fantastic. So we've talked about Jack a lot. Jack has over 20 years of experience as an attorney specializing in tax and estate and wealth transfer and business transfer. Jack, I'm not going to say anything more. Welcome to the call and tell us a little more.
Yeah, so I'll just give you my quick background, and it's a pleasure to be with you all today. I'm JD with a master's in tax. I didn't mean to do that. I was graduating from college. I didn't know what to do next. I'd gotten good grades, and I thought, well, I guess I'll go to law school. And then when I was graduating law school, I was graduating into like the .com bubble bursting. So I got my master's in tax because I just didn't know, I just, if they let me, I'd probably still be in school studying something. And then I joined an estate planning law firm in the DC area. So this is early 2000s. All of our clients had an estate tax problem because the exemption was $1 million at the time. And from then I worked there, as a drafting attorney for the first part of my career. And then in 2007, I had a complex life insurance case. We were drafting lots of ILITs as lawyers, and we were drafting non-qualified deferred comp agreements, and we were drafting buy-sells. I've probably drafted 100 buy-sells, but I had a complex life insurance scenario, and the advisor brought in somebody who basically has my job description today, which is to help advisors and their clients work with other professional advisors to make sure they avoid pitfalls and take advantage of opportunities. My focus since 2008, when I got on the life insurance side of things, has been to help clients and advisors, obviously, but help clients sidestep problems, take advantage of opportunities whenever there's a protection product in the mix. And today we're talking about buy-sells, and there's certainly opportunity and pitfall in buy-sells when they're funded by insurance products. So happy to be here, happy to be with you guys and to support Mission.
Fantastic. Thanks, Jack. So just as a final couple housekeeping items, just remember, whenever we're working with people, it's always a process. We are on Mission Financial Planners. All of us are certified financial planners. We do follow the financial planning process. That tends to surprise people sometimes because they think we're going to hit them with a product up front when what we're trying to do is find out what's the issue, what's the concern, what have you already done, and how can we help you get to where you want to be. And so for today, when we're looking at the business versus the people in the business, we're really kind of touching a couple of different issues here, right? And you can see on the left side of the screen there, continuation planning. Well, okay, when someone dies, and I'm going to turn it over to Jason and Jack for most of this conversation, but when someone dies and there's a valid buy-sell arrangement in place funded by life insurance, there's a liquidity infusion, right? That happens to the family of the person who died so that they get bought out by the firm, basically, so the firm can continue running. So there's a continuation element to this. Well, it is an exit. It's not the exit you hoped for, right? But it is an exit. But we're also doing protection planning, and hey, your successor is able to take over the business and keep it moving forward. When you think about types of insured buy-sell plans, there's a lot of different ways to go. We're going to touch very highly on some of these, but before we get into all the different types, I want to throw it over to Jason and Jack. So there was a big Supreme Court case last year that threw a little bit of confusion for people who don't live in the code like you guys do about when I put a buy-sell in place, are the insurance proceeds now taxable? Are they not taxable? What's the deal? What do I got to think about? So if we could start with some comments about that before we jump into the mechanics, that'd be fantastic. Who wants to go first?
Go ahead, Jason.
Sure. Yeah, I mean, that's a big part that threw a curveball to a lot of the planning community, because in the past it's always been, everyone knows insurance proceeds are tax-free when you get them, and that a lot of times with the buy sell, we do a lot of cross purchase in place, so that way I wouldn't have to have 3 partners with 6 policies. Each of us would have a policy and it would cover that other partner if they passed away. With this new legislation, it definitely has created some confusion, and I think that's also created some confusion around, do we need 6 policies? Do we need 3 policies? How many policies do we need depending on the partners? What are you seeing happen now, Jack, with how people are digesting this DOL?
Yeah, no problem. Great question. So just to rewind the tape, 2 brothers own a construction company. And if at the passing of one of them, the business will redeem the deceased's interest, so that the surviving brother's interest grows through reverse dilution, right? So I don't think they're 50-50. They may have been, but let's just assume they're 50-50. Me and my brother, I pass away, the business buys me out. Let's say we had 1,000 shares of stock. After the transaction, there's 500 outstanding shares of stock. They're all owned by my brother. He is now the 100% owner. A couple things with that. One, my brother didn't buy me out, and we're going to come back to that in a second and what that means. And there's some advantages to a cross purchase, and we're like creating cost basis, maybe some creditor protection stuff. We'll cover that, but that's the general transaction. And frankly, they probably shouldn't have been in that design. They should have been in a cross purchase. But let's say we are where we are, and if you were to add 3 owners, like say Jason, Matt, and I, then it kind of makes sense why we'd have a setup kind of like that construction company, right? The business is going to redeem, I die, the business is going to redeem me out, and Matt and Jason's interests grow from, in this example, 33% to 50, just because I'm no longer a part of the equation. Well, that's what they had in with these 2 brothers. They did a couple things that are not good practices. They had rules for how the company was going to be valued. They didn't follow those rules. Okay, they largely ignored them. And then the proceeds paid out to the company, and then under the terms of the buy-sell, the company would buy out the deceased brother. What the Supreme Court ruled, which surprised everyone, I don't think this was easy to see coming, is that the proceeds should be included in the deceased brother's estate, or the value of the company increases pro rata. So if we were 50-50 owners and a $3 million policy pays out to our company, 1.5 of that value increases my interest in the business there, and in this case, it costs estate taxes. So then there's the Connolly case. So there are things you can do to avoid the Connolly case, like you mentioned, get out of a redemption agreement. It's eminently easy with an LLC or an S corp. C corp maybe a little bit more work, but you can get out of. You could use a redemption with LLC or S corp. With a C corp, you probably want to set up a different structure, but it is easy to do it. What it does mean is you have to review your buy sells, so you don't look like Connolly.
Got it. So to recap that, and not to make it too simple, but essentially it sounds like it was good intentions, right? Hey, we need a buy sell. Let's put an agreement in place. Let's make sure that the policies are there. So they did all that right.
Yep.
But to your point, they didn't have the company valued appropriately. They didn't do all the other things they need to do
Correct.
to make sure it's valid. And because it wasn't valid, now it's taxable.
They're saying the Supreme Court's position was the insurance proceeds increased the value of the company. The buy sell was still valid, but it increased the value of the company rather than see that historically what people thought is, hey, the company when it buys me out has a promise, an IOU, a debit, right, a liability, right? So instead of the company going up by $3 million, or if it does, it increases the value by 3 million, but it's got an offsetting obligation and to acquire my shares, which are a $3 million devaluation. So technically the rule said, hey, we're going to ignore the value of that insurance because it is tagged to a liability, a promise, an IOU, whatever you want to call it. And in this example, the Supreme Court said, no, it isn't actually. It just raises the value, and a redemption obligation, which is what they had, does not reduce the value of the company. And they did some math on that frankly, in my opinion, I don't think was very realistic, but it's the Supreme Court.
Sure. So they're right.
Yep.
whether they maybe are or not. So
yeah, exactly.
So somebody dies, high level guys, somebody dies, whether it's a sole proprietor, a partner, or a shareholder, right? What are the just real high level here? Let's talk about sole proprietors first. What are really the biggest issues that you deal with from a sole proprietor standpoint when someone dies?
Sure, I'll go first, Jason. I'm going to go. You can go kind of hit maybe some more technical things, but I think you have your biggest concern is how. I like to make this practical. So, mom starts a company. Okay, she's done really well, but that means she didn't take a job somewhere. Right? She probably didn't. She had to fund her own retirement. She had to take care of her kids, take care of the family. Dad, maybe he has his own business too, but let's focus on mom. She built up her business, right? Eventually she plans on selling it or somehow monetizing it to support her retirement, but it's provided income and valuable benefits to her family. When she dies, what's the value of that business? What happens to it, right? If she's the one who drives it, if she's the wind beneath its sails, and she passes away or is unable to continue for some reason, and that let's say she drove that up to providing $500,000 a year for her family, and it just disappears overnight, what's the value of that business? Unless she has inventory or something to sell, her family could go sell, it's probably dropping to zero or darn close to it. So I think problems at death is that the financial engine powering that family is gone. And so replacing that value, replacing that income is number one on the list.
Jason, anything you'd add to that?
No, I mean, that's a valid point. The personal, and when it comes to sole proprietors, the personal financial plan is king, because he's right. As soon as they're gone, the income engine stops and you have to replace it. I think the only thing I would add is, some of the service businesses do have a book of business or a list of clients, and sometimes they can sell them on an exit if they already had some pre-existing relationships with other professionals that were in the exact same space that they're in, where they can do that. But that's usually something that you want to have pseudo organized before the event happens to you, right? Hey, Jack, we do the same line of work. If I ever get in a hammer, you come in and buy out my business, and it's usually a deep discount to what the value actually is.
So in other words, for the business owners out there, so in other words, you're running and gunning, you're 52 and suddenly you're gone, right? it absolutely behooves you, especially if you have a service oriented business, to make sure you're talking to some of your peers. Um, and like Jason and Jack, you both said, I mean, you're going to get a discount on it, but if the insurance is in place and you still get a buyout of some kind, it's better than not getting anything.
Yeah,
So,
here's a good way to think of it. Would you rather have a $5 million business that if you die, it becomes worth 200,000? Or would you rather have a $4,998,000 business, but if you die, it becomes worth 4 million?
yeah, exactly.
That's
Exactly.
the difference between having insurance and not.
Yeah, exactly. All right, let's talk partnerships. So somebody dies, right? And you know, let's just talk about reorganizing for a second. What's the impact on the business? And I know there's a there's loads of different businesses out there, and these are just some of the questions you can see on the screen here. But from a practical standpoint, guys, what are the real questions you've seen come up when this actually happens?
A couple things. One is, how are the loved ones of the business owner going to get taken care of? So that's one. Two, what about the business owners who remain in the business? Now, there's some technical stuff. You have the word reorganization up here. You
Mhm.
could distribute all the assets and contribute to a new partnership. You could have a partnership divide. Who knows what the future holds? But I'm
Right.
saying the things that matter the most, if it's the three of us and I'm the one who passes away, how are my kids and wife going to be taken care of? That's one. Number two, let's say I'm the breadwinner of our little outfit. Jason's the technician, and you run the place, but I've got the relationships, with customers. I go down, that's really bad for you guys, right? So it creates risk for you, and obviously risk for my family. And so having a good plan is the way to do it. Now let's play it out one more step. Let's say it's me, but I've survived my wife because, she passed away, let's say, and I've remarried, and she's, you know, not responsible. And now I have a blended family. I die. My family's now fighting over my estate, right? And my estate co-owns the business with you guys, and they're in an internal dispute.
Yeah.
That's not great for our business, right? So it protects you all and it protects my family to have a written plan that is going to provide the kind of our GPS for exit.
Yeah. Jason, any additional thoughts?
Yeah, I mean, everything Jack said screams continuity plan, right? Having a
Yeah.
business continuity plan lays the foundation for not only exactly defending yourself against all those risks, but also sets you up to grow your business because you know how you need to replace yourself. And that's what we're talking
Mhm.
about. If Jack isn't here, how do I replace Jack?
Exactly.
Mhm. Mhm.
Right. You got to, one, you want to buy me out. And two, you want to also either replace me. And it's not always so easy as like, oh, Jason and Matt will start taking over the customer relationships. Well, you know, they've already, if they're business owners, their dance
Right.
card is full. You
Right.
know, not easy.
Right. Right. Exactly. All right. So getting into corporations, I'll share a story from my personal background. I worked for a municipal bond shop on Wall Street for a number of years, and they had they found the founding family, the founding generation did a great job. The second generation did a great job, and then the third generation, which took over in the mid '90s, um, would scream at people if a paperclip went into the shredder by accident. So, and if you think about mid 90s to mid 2010s, right, that's the wrong focus you need to have as everything's becoming digital, everything is changing around you. And so the issue they had, of course, was there was a good leadership team in place there, but the heir was a family member, and the family member basically ran the business into the ground. And so I know we talk about heirs becoming shareholders, maybe active minority shareholders, even, or even equal shareholders. But to me, having your kids take over the business, while it may seem attractive, it may work in some cases. From what I've seen in my personal experience, is it's extremely problematic to have them come in suddenly and they are in control. And maybe they know what they're doing, but what I saw was they really didn't. So I'll turn that over to you guys as kind of a intro about, hey, somebody dies, now the kids are running the show. Is that the best thing for the business? Can a buy-sell plan help mitigate that risk as well?
Go ahead. You want to start, Jason?
Yeah, I'll start. I would definitely say what you're talking about is the support structure to the business owner, right? The key, we call it the KEG, the key employee group, because a strong KEG that knows how to run your company is the difference between the company failing and the company winning, and that key employee group being empowered to do that from that end. The question really is the relationship to the key employee group to the founder. And now you have a dead founder. Is the key employee group incentivized, to be quite frank, to stay around? Why wouldn't I just leave, Jack, and go to my competitor that'll pay me the same thing, and they're they have their stuff together, and we're not going through turmoil?
Because we had a stay bonus in place. We poured some concrete around your feet so you couldn't leave, or you wouldn't want to leave.
Yeah,
because we thought of this.
And that seems like the key, right? Is we actually thought about it.
Mm-hmm.
We took time out of the business to think about the business as opposed to always be working in the business.
Yeah, I call it a stay bonus, right? That's an informal name for some sort of non-qualified plan that provides incentives for your KEG to stay. And maybe those children are never going to be able to run the business, or maybe they are, maybe they're just going to be passive or active, but it makes their behavior and activity or passivity less critical because you've got a team in place that has incentives, real financial incentives to stick around and keep building the business up.
So, and this is something too, guys. If you look at this slide, the middle bullet point here, the middle figure here, the market, is there a ready market for closely held stock? I'm assuming that one or both of you have run into issues with firms where they thought that the stock plan was adequate, to handle any kind of transition. What are your guys' thoughts on this? Have you seen issues with this? Does it work? I mean, to me, it always feels like the insurance absolutely should be there so you can fund the stock purchase, right? But tell me what your guys' thoughts are on this.
I see it every single week. I'm working on it with two advisors right now who, yes, there's insurance in place. It is far not enough insurance that they needed. They've already done one buyout. So that one, like the oldest partner, they just finished buying out that partner. And the second oldest partner became ill. Now they've got to buy them out. And so these two younger people have, and they're making $1 million a year, and half of that is going towards the buyout, right? And this is their plan. This is their buy sell, right? No one's done anything wrong. But here you are. They didn't have DI, disability insurance. They didn't have, right? They still had some gaps in their plan, although they did a pretty good job. And here they are being forced to buy out another. Like, they were hoping that this is now they're going to be making $1 million a year. Guess what? You're not. You're going to be making, they're making 600, 700. They're making, but they're spending 300 a year buying out the older members. And they're like, when is it going to be my chance? When is it going to be my turn? They're the one carrying the load for the company, and they have been for a long time. So that whole market thing, usually the market for that business is the other owners, and having a good plan around it is critical, whether it's death, disability, or sinking fund to buy somebody out during life.
And Jack, to your point earlier about, would you rather have a business that's worth $4 million upon passing or 200,000 upon passing? Yeah. I know most business owners would much rather be making the $1 million versus the 600 or 700.
Yeah.
So Jason, any thoughts you would add?
Not always easy. It's not always easy.
Yeah, exactly. Jason, any thoughts you would add?
No, the only thought I would add is that what Jack mentioned earlier about business owners missing the boat on exactly what he described, the health issues, usually what takes a business owner out of their business, at least from my experience and what I've seen. And the fact that most business owners don't have protective measures to ensure that they can buy that business owner out can be a major cash flow crunch for a business. Now, he's talking about a real healthy business that can afford that crunch. There are some other businesses that are healthy when all pistons are running. Yes. And when you break one piston, now we have a problem. The cash flows aren't where they need to be, and we can't use those tactics that Jack are describing to buy the business out. We have to get more creative.
Right? Yep.
And of course, today we're talking about insured buy-sell arrangements. There's obviously other ways to do it, but I think hopefully it's apparent to anyone who's on the call or watching this on YouTube that, hopefully the income's there. Hopefully the business can absorb it if you're not going to use insurance at all.
And I'll just let me pause on. Oh, we're at why consider the insured method.
Sure.
I would just want to say one thing, and then Jason, you can tackle the slide. You're usually, not always, but usually using term insurance for a buy sell. It's not expensive, right? It's just if you get it when you're young, it's downright rounding error, right? But if you're getting it into your 40s or 50s, it's affordable for a successful business, right? And in many cases, it's just a rounding error. The key is getting enough of it, but it's just not expensive. So I think if you think to yourself, oh man, I don't like insurance, or what if I don't want to pay? It's not that much. It's just not a lot, right? And it's like paying your utilities. I don't like writing a check to the electric company, but I don't want the lights to go out either.
Right. Exactly.
Well, and that speaks perfectly to what we're talking about here with the insured method, Jack, because in my experience, the whole process of the insured method is you have a ready available market because you've set up the buy sell. You know what the computation is for the formula of what the value of that business is. You have a ready buyer and you have ready funds to do it. So there's not going to be a whole lot of contention around what's the value of the business now that somebody is no longer in it.
Mm-hmm.
All right. So estate planning considerations. What do you guys see as far as the number one estate planning issue that pops up? Someone has business has the buy sell in place. Somebody died. It gets executed. Now the funds have gone to where they're supposed to go to. What kind of estate planning issues typically crop up at that point if they haven't been thought about already?
Well, one, it could be what's the value of the business, right? You did that tech, like the agreement might have a stated value, as Jason mentioned, but the value is critical, right? So what would a willing buyer, willing seller, all the information they need to make a good informed decision? That's the real value, right? And when you die, your personal representative, your executor, they have to add up the value of all your stuff, your business, your cash, money owed to you, your cars, etc., your real estate, stocks, bonds, etc. They add up all that stuff. There's an exemption, which you have up here. It's about $14 million per person, 28 for the couple. That passes free of estate taxes. Everything north of that is subject to estate taxes. So if you, in this example, assuming you do everything right, the value of the business is going to be included in your estate. The value of that redemption, the value of that sale of your business, it's going to be one of those assets. Hopefully, you've got enough cash in your estate to cover the estate taxes if you're an estate taxpayer, thanks to the good planning you did on the buy-sell side. I think one of the critical things is if you are a business owner and you need to make sure you have liquidity, because if your plan is, hey, I want this business to go down to my kids, or something like that, that you don't want to be in a situation where you have to borrow against the business or sell the business to pay estate taxes. So you got to make sure you have a liquidity plan in place. And life insurance is a critical part of that. It might be part of your buy sell. It might be separate coverage, maybe owned in a trust. But you need to do the liquidity analysis while you're still alive, right? Afterwards, it's what should I do? You need to do it, you need to do it early.
Right.
So I do have two questions for Jack on that.
Go ahead, Jason. Go ahead.
One is, when it comes to the valuation of the business, Jack, if I have a buy-sell set up and I've created the formula valuation, does the IRS have to honor that formula, that is the right valuation, or can they object to that and say, no, Jack, you grossly underestimated the value of your business?
They could object. So in the Connolly case that I just mentioned earlier, there was a valuation. The problem is they didn't pay attention to the valuation. So if your buy-sell says we're going to get the business valued every 2 years, or it's a formula, right, for valuation, a formula is easier. But let's say if there's directions there where, like we each get our own valuation, appraiser, and then if they can't agree, they get it, like there's usually some sort of like rules. If there's a dispute, just follow all the rules, right? And then if you follow the rules in your agreement and you are true third parties to each other, it's not me and my kid, and it's just a device for me to get him a discounted asset, but it's true third parties, the IRS is generally going to respect it. It's when you don't pay attention to your own drafting and the
Mhm.
own rules you developed with yourself that the IRS could start challenging the value.
Okay, that makes sense. I think the
Yep.
second big thing too with consideration with estate planning is, say I'm one of the partners in the business and I pass away, could you have a control issue where the financial structures kind of close up on you and don't let
Oh
you
yeah.
take actions because you're not prepared for that from an estate planning standpoint?
Yeah, yeah, you could be in a dispute type situation for sure, right? And let's go really like practical. Let's say you work in a professional corporation, right? And state law says only a dentist can only own a dentist practice, a dental practice, right? So now you're in a situation where the market of potential buyers shrinks even more. It can't be your kid, right? Unless your kid's a dentist, right? So it gets really complex. But yeah, you could be, I call all of this what should I did, you know? You got to put it down in writing, you know? And by the way, again, if you're a business owner looking at watching this video, um, putting a buy sell in place isn't that expensive, right? I mean, it's legal work and wherever you're in your zip code, right? So it's not free, but it's not going to break the bank for you to make a plan. And if you're the majority owner, you're the one who probably is going to decide what that plan is going to be after getting legal and financial advice.
And I'll just underline what Jack just said there. If someone is watching this and they're concerned at all about the legal side of it, give us a call. We are not attorneys. We can't practice law. However, we have specimen buy sell agreements that we could hand to you that you could take to your attorney and you can say, hey, I'm looking for something like this. Most attorneys who do this kind of work like Jack has done over the years, they're going to take one look at that and know, oh, okay, we're talking to buy sell. Here's the type of business.
Mm-hmm.
And they're going
Yeah.
to take you through the process to make sure you get the right thing. But if you do want that, and this is more of for the people who are going to be watching this on YouTube and all that, give us a call, 888-339-0093. Once again, 888-339-0093. We'd be happy to talk with you and make sure you got what you need for going to talk to your attorney. Okay, we're having a great conversation. We are at about halfway through today. So I'm going to jump ahead a little bit here. And I think what we're going to focus on is the whys for the different types of businesses that we were prepared to discuss today. So I do want to start with sole proprietors. A sole proprietor is probably looking at, watching this going, well, wait a second, I run an HVAC business in Central Texas and I got 3 employees. This thing is done the day I'm done, right? Why should I even think about this? Guys, what would you say?
You can get you because there's more money in it for your family, and because you can maybe take care of those 3 guys that have helped or gals help build your success. The critical piece is who's going to buy it. Could it be a friendly competitor? Could it be one of those 3 people? Could it be a family member? Right there, you got, and then setting up an agreement between you and that prospective buyer. So, and often it's a key employee or several key employees together. And I can tell you this: if you want your employees to work harder, this is a great way to do it, right? If they know that there's a pot of gold at the end of the rainbow, they're going to, that's more. They're going to put more time in.
Yeah, absolutely. Jason, anything you would add?
I would echo that last statement Jack made because that is key when dealing with employees in transitions, is giving them the idea or the equity opportunity at the end of
Yeah,
the pot of gold, so they will work harder to build the business with you from that end. And in essence, it fixes itself, right? Because they already know how to run the business. You've already replaced yourself. You've already done all those things. So it's a no-brainer for them to come and take over the business.
exactly. And if you don't have anybody, get insurance for your family, because if you do kick the bucket and you're not going to get value from what you built over the years, that's an unforced error. It doesn't have to be that way.
Yeah, that's a good way to put it, Jack. That's a really good way to put it. Okay, jumping into partnerships. So talking about partnerships as well. Talk a little bit, if you guys could, and I know you mentioned it before, but just elaborate a little bit more on the need for having the formal agreement in place and the valuation. Because every now and then when I'm just explaining this to some small business owners where it's just 2 partners, they're like, well, I've got 250,000 or I've got 2.5 million of insurance. That'll take care of it. And when you try to explain to them, no, this actually puts it in place and formalizes it. Sometimes that gets lost in translation. Can you guys elaborate a little more on that?
Yeah, Jason, you want to go on this one?
Yeah, I would say, from the standpoint of absolutely, a lot of the business owners that we work with do have personal insurance and it can cover their needs. The challenge becomes back to what Jack talked about before, which was, hey, do you have a valuation for the business? How is it going to be considered when you do pass away from the IRS perspective if you have an estate tax problem, but also from the counter perspective of your spouse? They want fair valuation, and unless that's
Yep.
been determined beforehand, who knows what that number really is? It can be very disputable.
Yep.
All right.
Anything to add to that, Jack?
I would agree. I mean, and when you say, and just so the audience knows, when we say partnerships, we mean taxed as a partnership. So it could be an LLC or a limit LLP, or it could be, but the rules for how you can set up insurance, like remember I mentioned in Connolly that $1 million pays out and there's two owners, and so 500 gets allocated to my value of the company. You shouldn't have that problem with the partnership. The way you can set those up is you can make, we don't have to go through the boring like capital account rules, but you don't have that problem. It's pretty darn simple with something taxed as a partnership to have the business own the insurance and to redeem out the to redeem out the deceased. So it's a no-brainer.
Yeah, the one thing I'd say too, and Jason knows I'm going through this exercise of updating a trust and how much fun it is to go through funding a trust when you do an update and all that. The one thing as well, folks, is let's say it is just a two-person partnership, right? And your brothers or sisters or siblings or whatever, don't just assume. Do not just assume. Go through the process, because the process is what keeps families from tearing each other apart afterwards, especially when you're close while both parties are alive. It all changes. The dynamic completely changes once somebody passes away, and now real questions about money and buyouts and fairness start coming into play.
Yep.
I mean, it can get ugly really quick, really quick. All right, I'll throw the same question at you with corporations. I know we touched a little bit on corporations earlier in the call, but hey, I'm running a privately held corporation. We're good. Why should I do this?
So that you're not in business with your deceased partner's new wife or children or new ex-wife's new husband. You do this to protect your interest in the business. So you want your partners or co-stockholders to do this. And then I do it because I want to make sure my family's not reliant on my partners. They might be awesome. Don't get me wrong. But they're suddenly, if it's the three of us and I'm the one who goes, you guys' workload is going to go up by 50%. Don't you think it's fair you get paid for that? Yeah. Well, where's it going to come out of? Maybe it's going to be coming out of the part that would be going to my wife or kids, right? So in a situation where you're going to be working 50% harder, you should be compensated for it. Where's it going to come from, right? So if you put a plan in place, you buy me out, now you're going to be working 50% harder. You're going to get 50% more money without it coming out of my wife's mouth and my kids' mouths, if that makes sense.
Absolutely. Jason, anything you would add?
No, I mean that nailed it right there, is that whole part, because they don't think about that when the situation pops up. Well, we got money in the corporation, we can keep going, so forth, so on. But that dynamic can definitely cause some problems. And then most of the time, the spouse doesn't want to have anything to do with the business.
Right, but her new husband might really like to get it.
Exactly.
Take a look at the books and records, right?
Yeah, exactly.
So, all right. Taxes. Let's just take a minute. Let me jump ahead a little bit here because I know we're getting a little close on time. All right, so let's take a few minutes and just talk about taxes and insurance valuations, because Connolly was all about that, right? They didn't follow their own. they didn't eat their own cooking. Yeah, exactly. But let's just talk about taxes in general. I know we talked a little bit about the estate credit, but we also talk about, hey, you know what? These buyouts are happening. What's really happening from a valuation standpoint? What does that mean from a tax standpoint? I don't know who wants to try to tackle that first. That's a big ball of yarn. We're trying.
Yeah, I got it. Yeah, I'll tell you how insurance is taxed, and then I'll tell you what happens on a redemption from a tax perspective, and then a cross purchase. So we kind of hit all three, right?
Okay.
Insurance is taxed like essentially like municipal bonds. You use after tax dollars to buy it. And if it's a permanent policy and there's growth in the cash value, that growth is income tax free. And then the death benefit is income tax free. So think of it like a muni. You buy a muni, it grows in value. That's not taxable. You sell it. It's not taxable. Think about a Roth. It's taxed just like a Roth. Okay. That's life insurance, unless you have an unforced error. Okay. So kind of like, after tax dollars, income tax free growth, income tax free distribution, i.e. death benefit. When I sell my business, when I die, all the assets that I own in my estate get an increase in cost basis, get a step up to my cost basis. What does that mean? That means, let's say I have Apple stock. I bought it at $10 a share. It's worth $400 a share. And so if I sell it, it's got $390,000 of unrealized built-in capital gain. Guess what? That's the day before I die. The day after I die, my basis is now equal to the value. So I sell it, there's no gain. Same thing happens with your privately owned entity, right? So if I own my business and it's redeemed from my business, or if Jason, who's my partner, buys me out, my family should not be paying any capital gains because I got to step up in basis. Where it gets interesting, and there is a distinction in why, all things being equal, cross purchase is better than a redemption. Meaning, rather than Jason and Matt's interest growing in our company by reverse dilution because the business bought me out and they jumped from 33 to 50 because I'm not there anymore. Instead of that, because they don't get basis for that, they'd rather buy me out. So let's say my interest is worth $10 million. They each pay $5 million to buy me out of the business. They do it individually. Then the next day they sell the business. The first $5 million that they spent is return of basis. It's not taxed, right? So it's just like that Apple stock example I gave you. If the business redeems me, that they don't have that $5 million of capital, sheltering their capital gains. So all things being equal, you'd prefer a cross purchase over a redemption agreement, right? From the seller's perspective, it makes no difference. But from the buyer's perspective, it does, because it creates basis if you do a cross purchase, which helps you when you sell the business down the road. Make sense?
Mm-hmm.
Yep.
Jason, anything you would add?
No, I mean, Jack covered it really well with that and the whole cross purchase and bringing up the basis, because that's a huge win for the people that stay in the business.
Yeah. Yeah. I mean, if you play out the math, if you bought me out each for $5 million each, we have a $30 million company, right? Let's say we had no basis because we started in our garage. You guys buy me out, then you sell, right? If it's a redemption, when you sell, you each have $15 million of capital gain, assuming there's no growth in the business, right? So because it's 10, 10, 10. After I die, it's 15, 15. Still a $30 million business either way. You sell it, $15 million of capital gains. Okay. Assuming a 20% bracket, it's $3 million in taxes each. Now, let's say the same set of facts happened, but you bought me out first. So you each bought me out for $5 million. Now you go and you sell the business next day for 30 million. Same business, hasn't grown in value. You have, instead of having $15 million value with zero basis, you have a 15 million value with $5 million in basis. So your capital gain exposure is on 10 million. So assuming a 20% bracket, your taxes are $2 million. Still bad, but $1 million better, right? So because you bought me out, you created $1 million of takeaway value, after tax takeaway value for yourselves, because you structured the buy sell strategically. So we should, if for those viewing, Mission can look at these buy sells and review them for you to make sure they are from a tax perspective optimal and strategically designed.
Yeah, Jason, you want to talk a little bit about that review process?
Yeah, I mean, the review process for us is we work in tandem with Jack and his team in regards to reviewing these buy sells. And you're going to send in your buy sell. You're going to explain to us the formula or how you computate your business value. And we're going to work with Jack to go through that and find any opportunities to improve that buy sell. A lot of opportunities that I see as we review those buy sells is, while the buy sell is initially structured for a death event, what happens if somebody just wants to get out?
Yeah.
There should still be rules and terms around how that happens. And a buy sell can serve that function too.
Yeah, and disability, right?
Yeah,
Business owners more likely to become disabled than die during their working years.
right.
So they have disability buyout insurance. Again, it's not going to break the bank.
All right.
Yep.
All right. So 4 steps today, right? If you're someone who's looking at this for your business, valuation, guys, number one. Number two, what kind of insurance products are you actually going to use? Number three is insurability. That's a fancy way, or that's underwriting basically.
Yeah.
And then of course you got to arrange for premium payments. Just touching on this real briefly, kind of as a summary comment for everyone, the valuation is absolutely critical. If you've picked up on anything during the course of this conversation, when you think about Connolly, when you think about just what's the, yeah, how much are we supposed to pay out? You can't just wing it. You're just going to open yourself up for tons of issues if you're just going to be like, yeah, I got an insurance policy. I'm going to use it to buy them out. Okay. Um, like Jack also said, most of the time you're going to use term insurance for this. You're
Mhm.
not going to use a whole life policy. You're not going to do something that's going to cost thousands upon thousands of dollars. You're going to look at something that actually fits the need for the time period that the need needs to be filled. Okay. Um, Insurability, we talked about underwriting already, and then of course arranging for the premium payments. In the short term, though, you also have to get your buy-sell arrangement drafted. If there is existing insurance, this goes into what Jason was talking about in terms of reviewing what's in place. What is in place currently? Because every now and then, and we actually had this happen earlier this year, 2 or 3 partners are in their mid 70s, one partner is in his mid 50s. Well, guess what? Their 20-year terms are now expiring on their buy sell, and they don't want to retire yet. Well, suddenly that super affordable term insurance is just no longer available to them. What should they do now? Right? How does that then affect what the buy sell arrangement needs to look like going forward at this point for the business? But also, are there other funding mechanisms they should be looking at? And then we talked about disability. We'll get into that more detailed at the end of the month here. But review. We talk about this in personal financial planning. We also talk about it in business planning. Guys, I'll turn it over to you each for a couple minutes of closing thoughts on this. How important is it to make sure, and this is a loaded question, how important is it to make sure that you're reviewing this at least annually? How important is it?
You should review your buy sell when there's changes in tax law, which there was last year. You should review your buy sell at the big life events, right? Like death, retirement, new baby, right? Whenever you're thinking big, whenever you zoom out to think big picture, you could have your buy sell reviewed. It's probably not going to take a ton of changes, but each time. But I will say you'd be surprised. Like I probably review one buy sell a week, and provide, kind of feedback on it. I would say 50% needs some sort of TLC of some kind. So you should know what's there.
Jason, what would
Yeah,
you add?
I would say the review part for the buy sell too is don't miss this is those key employees,
Yeah,
right? Because if something hits the fan, that's the most likely candidate to buy you out. It's not taking it out on an open market and saying, hey, I'm dead, I'm the spouse, go ahead and buy me out at a great rate, because that's not going to happen.
correct.
So it's those key employees, making sure that you consider that in a buy sell, figuring out where they're at in the process, any leadership that you can do to help improve them, to get them in a solid position to feel confident to take that business over if something were to happen to you.
All right. Thank you, gentlemen. Again, we're Mission Financial Planners. Today's topic was business succession issues. Um, we have a full slate of events lined up for this month. Next week, we're actually talking just about Social Security. It's been in the news a lot lately. So we're just going to review the program again. We've also have I think a great bullet point format in terms of some of the fundamental questions people are starting to ask. We have our client appreciation event coming up on April 17th at the San Antonio Food Bank. We're going to send out a bunch of stuff about that, but that's a pre-Fiesta event. So if you're not familiar with Fiesta, San Antonio, that's an annual spring party that happens every year. And then finally, we are going to, at the end of the month, have a disability version of this presentation that we're going to be doing as well. So we got a lot going on in April. If you do have any questions, sorry, go ahead, Jack.
I was going to say, nice. I'm glad to hear. I mean, that's quite a lineup. I especially love the disability stuff. That's a
Yeah,
good one.
yeah, we're nothing if not consistent in terms of trying to get stuff out to people. But
Yeah.
if you do have any questions on anything you saw today, feel free to reach out again, 888-339-0093. You can always contact me directly at 726-727-6581. And you can always contact Jason directly at 726-727-6583. Otherwise, gentlemen, happy April 2nd. Jack, thank you so much for your time and
My
your
pleasure.
expertise today. And then we will be in touch with everybody soon. Thanks again.
Thank you.